Give it up for Danielle DiMartino.
Danielle DiMartino.
Danielle DiMartino Booth.
Sherry, let's get back to some analysis when it comes to the latest inflation numbers and the impact and what to expect from the Fed. QI Research CEO and Chief Strategist Danielle DiMartino Booth joins us now. Danielle, really great to have you with us. When you take a look at the inflation picture, we know that some of these factors are one-offs, like the impact of the devastating LA fires. But broadly, given that we're getting these readings and this sort of heat even before the true impact of Trump's tariffs, does this really complicate the picture for the ability for the Fed to move further?
Well, I certainly think that it makes the Fed's job a little bit more difficult in the near term. But you are very right about the about the one-time factors. We saw used car prices, for example, rise 2.2% on the month. A lot of that was a seasonal adjustment, the same seasonal adjustment that we see come through every February. And we know that we had 3 massive hurricanes in the United States, in addition to the fires in Los Angeles that caused a ton of replacement buying in December and into January that has since come off. January car sales missed here in the United States. We also had hotel prices spike by 1.7%. And we know that Los Angeles is the 6th largest hotel market in the United States, and that those hotels were really full as that city was largely evacuated. So many one-time things that we've seen. Bloomberg's Anna Wong, however, pointed out that the seasonal factors that were built in showed that the 6-month annualized core CPI had fallen to 3.1% on a 3-month and 6-month annualized basis, with some large seasonal adjustments that we got in going back to 2017. So I think in the months that come, in the very near term, that inflation is going to become much less of a concern for the Federal Reserve.
Danielle, what about the impact of President Trump's tariffs? Supporters of those tariffs sort of are very sanguine about the inflationary impact. Do we have a clear picture in terms of how sort of structural they will be?
It's very difficult to say because the precedent of 2018, 2019, the tariffs were very targeted. And in fact, what we saw was contracting global trade that ended up manifesting here in the United States as slower growth. We learned that from reading the Federal Reserve's 2019 meeting transcripts just a few days ago. So I think that there are conflicting influences in terms of whether or not we slow growth more because we are a global trade economy, or whether the tariffs do flow through to inflation. In the case of 2018-19, we actually saw the consumer price index drift down as a factor of time as job losses began to mount in 2019.
The issue right now is that it's really difficult to calculate the impact given all of these different policies that the president is pursuing, right? Especially when it comes to also adding the fact that immigration could be tightened. Are there any estimates right now of how the net impact would be when it comes to the U.S. economy, given that the labor markets would also be affected?
You know, it's hard to put all these pieces together because, of course, we did not have the threat of mass deportations when Trump was last taking occupancy of the White House. That is present now, but we are indeed seeing, with revisions to to payrolls numbers, that the construction jobs have actually been cooling. So the risk is not necessarily what you think it might be. In addition to that, Bloomberg does a great job of tracking bankruptcies BC-wide go. We've already seen 23 bankruptcies of companies with liabilities of $50 million or more announced this year, compared to 14 at the same time in 2024. And we've also had 2,800 store closures announced since the beginning of the year, just since January the 1st. And that compares to about 7,300 for all of 2024. In other words, we have a lot of loosening in the labor market in real time that's going to act as an offsetting factor to what we see potentially with deportations.
Given the risks to the economy, does it make sense for the markets to hedge and just get out of some of those more U.S. consumer-focused names, discretionary stocks, for example, that could take a hit if the U.S. consumer takes a hit?
Well, that is certainly one of the calls that we have this year at QI Research. We did see, the headlines today were filled with the fact that egg prices rose 15% in the month of January. They're up 52% year over year. And yet we only saw spending at restaurants rise by 0.2%, 3.4% year over year. So you're absolutely correct to point out that in areas where we see discretionary spending, we're seeing a pullback on the part of U.S. households. We're also seeing that play out in an increase in U.S. household bankruptcy filings as well. So a lot of concerns here for the consumer discretionary sector. We're also seeing consumer packaged goods companies really take it on the chin as well, because U.S. consumers have become very cost conscious about purchasing brands when they're having to pay so very much for the essentials such as eggs.
QI Research CEO and Chief Strategist Danielle DiMartino Booth, good to have you with us. Thank you so much. And of course, oil also a key factor when it